Hey everyone, before we dive in, just a heads up. This video is proudly brought to you by insightfulvalue.com, where we dig into undervalued opportunities and break down the numbers without the fluff. This review is for informational and educational purposes only, not financial advice. If you like this kind of content, hit like, subscribe, and drop your thoughts in the comments below. Today we're zooming in on UDR, Inc., UDR, a U.S. real estate investment trust focused on multifamily residential properties, basically apartment communities. UDR owns or invests in well over 50,000 apartment homes across some 21 markets in the U.S. The company is part of the S&P 500 and touts over 50 years of experience in acquiring, developing, renovating, and managing multifamily real estate. So what's going on with UDR's stock lately? It's down. Recent trading hit a new 52-week low at around $35.86. Analysts have been cutting price targets. For example, Wells Fargo lowered its target from $48 to $42. Meanwhile, the company just declared its latest quarterly dividend of 43 cents per share, translating to roughly a 4.8% yield at current prices. From a value analysis lens, some key strengths and red flags. Strengths: why someone might see upside now. UDR has long pedigree in its niche and a substantial real asset base. It still generates strong operating cash flow. In 2024, cash from operating activities was approximately $876.8 million. The dividend track record is impressive. UDR has paid consistent quarterly dividends for decades and recently declared its 212th consecutive quarterly dividend in October 2025. If interest rates moderate or apartment demand remains resilient, there could be a multiple expansion or recovery in sentiment. Risks: why caution is warranted. The dividend payout ratio appears extremely stretched. Some sources show absurd ratios, e.g. 452%, which suggests the dividend may not be fully supported by earnings or sustainable in a stress scenario. In 2024, net income was modest, approximately $89.6 million compared with past years, indicating volatile profitability. UDR carries a heavy debt load. Total debt in 2024 was over $5.8 billion versus equity of approximately $3.4 billion. REITs are sensitive to interest rates and inflation. Rising rates squeeze margins and property valuations. Rental markets in some regions could soften. Vacancy risk, maintenance, and capex burden could rise. Dividend history. Over recent years, UDR's quarterly dividends have hovered in the 0.42 to 0.43 range. The annualized dividend is about $1.72, giving a yield in the 4.7% to 4.8% band at current prices. While the consistency is attractive, the question is whether earnings can fully support it long-term. Why might the stock be down now? High interest rates hurting real estate valuations. Sentiment risk around stretched dividend coverage. Sluggish earnings or pressure on margins. Macro risks. Inflation, credit tightening, that weigh on REITs in general. Could it bounce back soon? If rates stabilize or fall and rental markets hold up, there is potential for valuation recovery. Also, if UDR can improve operating margins or reduce debt, that could instill confidence. But the upside is not guaranteed. It depends heavily on macro trends and internal execution. If you're curious to dive deeper into UDR or other stocks, head over to insightfulvalue.com. We deliver in-depth breakdowns of undervalued companies in a clear, actionable way. Thanks for watching. If you found this useful, please subscribe, like, and leave your comments below. More content coming.